What's up, everybody? Nate here. And the Federal Reserve just raised its benchmark interest rates again, this time by around 25 basis points. Now, Wall Street and pretty much every other economic expert out there had been expecting this move. In fact, the stock market had priced in the move by 100%. Raising interest rates for the Federal Reserve is nothing new. They've been doing this for a little over a year now. And what they do next might end up creating a huge boom and opportunity in not just the stock market, but pretty much every market. So today I want to talk about what the Federal Reserve just did, who exactly that is going to affect, and what we can expect to see happen from these moves and from the stock market in the future. So the federal funds rate now sits at around 5% to 5.25%, its highest level since around August 2007. Like I said before, the Federal Reserve has been slowly raising their interest rates for about the last year and a half or so, starting from 0% all the way back in 2021. The reason is because of inflation. So because of all of the extra money printing that went through our economy during the pandemic and really low interest rates, well, that led to a huge economic expansion. People were borrowing money at record rates. We're talking about businesses, we're talking about investors, and we're talking about consumers. That's why we've seen the stock market and the housing market all hit record highs over the last couple of years. But that also created a lot of really highly elevated prices, i.e. inflation. So what the Federal Reserve can do is use its monetary tool of interest rates to either bring inflation down or make it go way back up. Right now, they're using their interest rates to try to lower inflation because over the summer of 2022, it hit a record high of around 9%. That means that the goods and services of everything in our economy on average is going up by around 9%, which means people need a whole lot more money to buy all of the same things because the buying power of the money that they do have is going way down, and that's dangerous for a country and that's dangerous for an economy. Not to mention, people just don't have enough money to buy all the same things that they could before because everything is way more expensive now. So the Federal Reserve raises their interest rates to lower demand because now it's harder for people to go out and borrow money. It's harder for people to get money, which means people don't spend money, i.e. inflation goes down. So that's nothing new. It's been a whole spiral of the Federal Reserve raising interest rates, but now they have completely flip-flopped in the language that they've used in their most recent report. Typically, they have in the report a phrase or something along the lines of, "We will raise interest rates where we deem appropriate, and we believe that an interest rate hike in the future may be appropriate," except for that line was completely cut out of this most recent report. Instead, they have replaced it with a line that basically says they are going to take into account our current economic conditions when they assess new rate hikes in the future. And I don't know if you've noticed our economy lately, but it's kind of in shambles. So this is leading the stock market and many investors to believe that the Federal Reserve might be at the end of its rate hike cycle, and it may actually start flip-flopping and lowering rates sometime in the future. Now, what exactly is going to determine if the Federal Reserve raises rates or actually lowers them or pauses them completely in 2023? Well, there are a few different factors. The first is the jobs market. Like I said before, when you have an economy where prices are going up, well, the first thing that typically happens is workers don't have enough money to go to the grocery store and buy all of their necessities. So that means that they have to make a whole lot more money, and the vast majority of Americans get their money through their paycheck at their 9 to 5. So that means it's on the employer to raise their rates. So now they raise all of their employees' wages and their wages go up, and that means workers can now buy a whole lot more things, which is good for the workers. But the company that ended up giving those employees a raise, well, they now take on an additional cost because now if everything stayed exactly the same, they're in the hole. Everybody got a raise, but no prices changed. So that leads a company to raise prices in order to compensate for all of the raises. Not to mention, we have a ton of money in our economy right now. Like I said before, at the start of 2020, we had around $3 trillion in circulation, and today we have over 20 trillion. So there is a lot of dollars out there, which means there's a lot of money that still needs to be spent, which means you have high demand. Companies have to sort of work out that high demand by making a lot more things. So they produce more, but again, that comes at a cost. So that means they have to raise prices because they have to build more factories and they have to hire more workers. With companies then raising prices for all of their products, well, then it goes back to the workers who, once again, because those prices are a lot higher now, they don't make enough money. So if prices continue to go up and there isn't an equilibrium in the market, well, now you have something called the wage price spiral, where workers need a raise, companies give out a raise, and it pretty much just continues forever until your money is completely worthless. Well, that is something that has definitely happened over the last few years or so, and the Federal Reserve is really concerned about wages, but they're are also really concerned about something called maximum employment. In the Federal Reserve's eyes, there is a maximum amount of employment that people can have in the United States. Right now, our unemployment rate is around 3.5 or maybe 3.7%. The Fed believes this is way too high, and we need to actually increase unemployment in order to bring down inflation. And their argument here is there's way too many people making way too much money and buying too many things, which keeps prices way too high. We have gone past our maximum employment. So the Federal Reserve is raising interest rates so that way there's a lot of dollars that gets sucked out of our economy. Remember, raising interest rates affects borrowing. This is how investors invest money. This is how businesses take on debt in order to grow. Without any of that liquidity going into businesses, well, now they don't have money to give back to their employees, which means layoffs and more unemployment. You've probably heard the phrase over the last couple of months that the labor market is really strong, and that is definitely true. Even though the Federal Reserve has been raising interest rates really aggressively, the labor market is still hanging on, and we still have a ton of jobs out there and a lot of people employed. But the Federal Reserve wants to soften the labor market, and it wants a lot of these businesses to not have as many employees, so that way there is less spending in our economy. That is the labor side. And then the other side that will determine if the Federal Reserve raises interest rates or lowers them or maybe even pauses them in the future has to do with price stability. The Federal Reserve wants to kind of keep supply and demand in equilibrium, and right now with them raising interest rates, well, their idea is that if demand goes way down, then that will give supply enough time to kind of catch up to where demand should be. That will create an equilibrium in the market, and then you won't have that wage price spiral because people are not going out and buying an excessive amount of things anymore. Instead, they're only buying what they can afford, and that means that prices won't continue to go up like crazy like they have been going up over the last couple of years. Now, the Federal Reserve can have a direct impact on the labor market. Them raising interest rates really aggressively is going to hurt businesses. It's going to hurt businesses and investors and consumers' ability to borrow money. But what they don't have as much control over is price stability, because our prices aren't just set from factors here in the United States. Geopolitical tensions, economic lockdowns, strikes, you name it, all of these different things affect prices around the globe. And it's not really something the Federal Reserve has much control over. They can't go to a business or they can't go overseas and tell a country that they need to lower their prices. They can't really control things in that way. So their monetary tool of interest rates is not really going to affect price stability that much. They just have to hope that economic turmoil and geopolitical tensions don't cause, for instance, gas prices to continue to go out of control, or other energy prices or different things like that. And their hope is that they have a big enough impact on the labor market that things kind of fall into place on their own, regardless of what happens with geopolitical tensions or prices across the world. But like I said, more geopolitical tensions and more strikes and more economic lockdowns and things of that nature, well, that's just going to continue to cause inflation to go higher. And as long as inflation is going higher, the Federal Reserve is going to have to do something, and the only tool that it has is interest rates. And those interest rates are going to impact businesses and investors and consumers and all of the markets that they're attached to. But sort of the vibe that we get from the Federal Reserve right now is they believe that the country and our economy and our dollar is going in the right direction, which means they might actually pause interest rates starting during their next meeting, or completely flip-flop and start lowering them, and that would cause an economic explosion. If the Federal Reserve was to see that inflation is now starting to go down, which it has been trending down over the last couple of months, and the labor market continuing to soften where we don't have as many job postings and there is a slight rise in unemployment, well, that could signal that the Federal Reserve is going to lower its interest rates. And like I said before, the Federal Reserve is going to be looking at every bit of our economy here in order to determine if they need to lower their interest rates. And we have a lot of problems in our economy right now. The banking sector has been hit really hard by Federal Reserve interest rates and lower consumer spending. Not to mention, we have something called a credit crunch in the economy right now, where it's really difficult for Americans and investors to get their hands on any type of credit because interest rates are so high, and banks are getting really afraid to loan out money. They have to be very careful because of all of the economic uncertainty right now. The Fed is looking at all of that, and lowering their interest rates would create a situation where many people are going to have easier access to credit. Depending on when they pause them and how far they lower them, well, that could have a huge boom in the housing market, right? Because now mortgage interest rates are going to start going down because it's easier for banks to borrow money from the Federal Reserve. Stock market could go way up and private equity markets could go up as well because investors have an easier time borrowing money, so that way they can get a higher return on their investment. And some other markets like the cryptocurrency market could explode as well as more people have more access to credit. And this is not just me speculating here, because we have already seen this happen. In 2020 and in 2021, we saw this huge economic explosion all because of low interest rates. The Federal Reserve lowered their benchmark interest rates to near 0% in response to the pandemic. They wanted to incentivize people to go out and borrow money and spend money, and that meant that everything was going to go up, and all of this money was going to get pumped into our economy because they didn't know what was going to happen next. So they'd rather things get a little bit inflated rather than our entire economy essentially tanking. Other economies and other world governments followed suit, so we had 0% interest rates pretty much across the board for every single country across the world. At the very end of all of that though, we saw record high prices in the stock market. So asset prices hit a record high. Bitcoin hit around $65,000. The median price of a home hit around $400,000 as well. Everything went up in value because there was all of this demand. As soon as the Federal Reserve started raising their interest rates though, well, everything essentially fell down hard because it was harder to do everything. Like I said, that could completely flip on its side if the Federal Reserve starts to lower its interest rates, and it looks like that might be happening sometime soon. Now, I'm no Nostradamus. I don't have a crystal ball in front of me, so I can't tell you what's going to happen in the future. All I can tell you is this could create a massive opportunity for you to buy assets now at a low price because they could go way, way up sometime soon with all of this demand about to be pumped into the market. Always do your own diligence when buying stocks, when buying real estate, pretty much any asset that you buy. You always want to do your own research and your due diligence before buying. And again, the key to being a really successful investor and the key to kind of seizing these opportunities from the Federal Reserve or our stock market or just our economy in general is to have a plan and to know what to do with your money. You cannot control what the Federal Reserve does, and nobody knows what their next decision is going to be. So that means you have to create a long-term financial plan that is going to benefit you no matter what the decision is. It is always a great time to become an investor, no matter where our prices are at, no matter what the stock market or our economy is doing, because the fact of the matter is, even when we have seen economic depressions and recessions and stock market crashes, our economy and markets have always bounced back to set new record highs. And as far as I'm concerned, there isn't really much evidence to support that that won't be the case in the future. So creating a consistent plan today where you can grow your wealth no matter what happens in our economy can ensure that you are always financially successful. But it always helps to know when to buy more and when to hold off. But right now, the Federal Reserve is signaling that a boom might be on the horizon. But if it actually happens, well, we'll have to stick around and find out. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.